Welcome to TMS Insights, the back end of February. More reporting news to bring you. Ben Clark and Jeremy Hook. Ben, it's been a continuation really of volatility.
Yep.
While we've been fed a steady stream of overall good earnings news, but for some reason the market finds a way to claw it down. Let's maybe have a look at some of these results individually. One big one that was released yesterday was Wesfarmers. We hold a lot of Wesfarmers, so overall good, but obviously one factor drawing back the business overall.
Yeah, look, I think you look at the headline sort of numbers and you thought it was pretty soft, but it was all due to Wesfarmers have a large meteorological coal division, and the profit in that area fell markedly over the last year, and some businesses that are related to the mining sector, but the core businesses did very, very well. And so I guess, we'd sort of say it was a pretty good result.
Yep.
But those other areas won't contribute too much in the future. Still probably a good hold.
Yeah, just interesting too that the return on equity in the Bunnings business, home improvement, over 30%. And that's for a period while Masters was still existing as a competitor. Yeah. So quite interesting there. Also too, we'll be sending through to clients Ben's video. Ben was interviewing Richard Goyder, the CEO on Sky Business yesterday, so that'll be of good interest, so we'll send that through as well. Seek, the result there this morning on the conference call, Andrew Bassett, really, really good numbers again.
Great result, and so good to see a share price actually go up on a good result, because we haven't seen that much lately. But I think a lot of clients have certainly been asking, they can't get their heads around looking at the numbers and then looking at the share price reaction. Yep. And I've got to say, I've struggled with it at times as well. But what we've sort of been saying is it's all about expectations. And there are some businesses which the market obviously felt were going to do even better than great numbers. And once just great numbers were delivered, there's been a short-term sell-off. And then there are businesses like Seek, given the employment market at the moment, it's not great. I think expectations were quite low, and they've delivered a wonderful set of numbers, and then we've seen a big kick up in share price. So, the management of this company just continues to do everything very well, and it's probably a buy at these levels, I reckon.
Yeah, exactly. And the market certainly thought so today, so it was good to see that move. QBE reported yesterday. Again, it wasn't the best of numbers, but again, that was a reaction which was quite positively received by the market.
Yeah,
$1 gained on the share price. But it's been hard work, hasn't it?
Big time. Again, I think there's low expectations with this. We looked at the numbers and thought an improvement for the first time in 5 years, or 5 insurance divisions were profitable. So I think they're doing as well as they can, but the macro environment's still very challenging for them. But yet a big kick up in the share price. And, QBE to me looks cheap, but, it's had its challenges over the last few years, hasn't it?
Cheap and a bit nasty, I guess, is probably how the market would see it overall. The funds management space is interesting. We talked last video about Challenger, which is at least partly a fund manager. But Platinum and Magellan are 2 stocks which have reported. Also Henderson. And they've grown their earnings very well, but there are differences between them.
Yeah. I think Magellan reported a 45% earnings growth, and just an amazing set of numbers. That's pulled back markedly in share price recently. It's probably starting to look pretty good buying again, I reckon. Platinum, fairly stable.
Earnings growth was up, but there's not been the growth in the funds under management. So performance fees kicked in, earnings up 20%. So that's good, but again, they warned about how the second half might play out.
Yeah.
Marginally cut the dividends, so that's an interesting sign about management confidence.
Yeah, and Henderson Group reported really good numbers, but again, I think are a bit cautious about the outlook for global equities, and again, so I've just calmed down investors, and there was quite a big sell-off in that stock, but which I think again could be a pretty good opportunity. I mean, these are all great businesses, but they ride the ups and the downs of the equity markets sort of on steroids. When markets are good, they're great. When markets are bad, the share prices aren't great.
Yeah.
And they're going through that period at the moment. But I think we'd agree Magellan's probably the standout.
Yeah, it's a great stock. It's got beautiful return on equity, good dividend these days too, and so they look good. Just to probably take that discussion into some stocks which have been pretty good performers over the last year or so, even though the markets have been choppy. We might put the tag high flyers around them, but stocks that have come out in reporting season and just been pulled back by whether it's expectations, a general market thematic, which is bearish or whatever it is. But Certex, been a good performer, good result. Isentia, another one which has done very well, and there are others. But to talk maybe about those couple.
Yeah, look, I think Certex delivered sort of 45% profit growth and maintained its guidance. Isentia, a little bit messier. They bought a business called King Content during the year, and the acquisition costs, etc., probably made the headline numbers not look as good. But in both cases, very strong earnings growth still being delivered and still being, investors still being told to expect to continue. But I think they fall into this category where, the numbers were we thought fantastic, but they were not out of the ballpark. And with that and with the general market environment has come selling. Because, I think there's still this feeling from fund managers and investors that they're looking for places to take money out of the market. And it's those sort of businesses that have had a really good 12 months. There's some liquidity in the stock because of the announcement that's occurred, and it gives managers an ability to take some money out and sort of do what they want to do with it. But I still think give them 3 to 5 years and they're going to be businesses that are worth more money.
Yeah, and it would be fair to say that some of them get a bit too loved.
Absolutely.
Leading into numbers and in a market which has clearly got an edge of bearishness about it. PE expansion is hard to find, so if you get a bit lofty in your valuations, you're a bit vulnerable to selling. But these can be short-term factors, and they ride out when you've got the earnings growth. Airports, we talked last year about Sydney Airport and our views on that. Auckland Airport just powers along, doesn't it?
Yeah, and look, actually had a profit upgrade with its result. Stock hit an all-time high this week. I think it was this week or late last week, and it's holding up very well. And as we sort of said when we talked about Sydney, this business has a lot less debt on its balance sheet, and the conservative gearing, and this thematic of the Chinese middle class starting to want to go and see the world and travels, generating very strong passenger growth. And Auckland Airport's probably it's probably about 10 years behind Sydney Airport in how efficiently it's running the airport and making money out of an airport. It's got a lot more probably of a runway to go, and I reckon still a hold, but probably looking a bit toppy at these levels.
So we've got a couple of days of reporting season left. You get a couple of big ones like Woolworths is still to report tomorrow, for example, but most of them are done. I mean, to get a summary of the season and to leave investors with an idea of how we feel about the market, this season has been overall quite good.
Yep, I'd agree. And I think if we went back to the end of January and we thought we'd get these sort of results, I probably would have thought we would have got a bit more out of share prices. But it really is, it's macro factors that are pushing our market down versus, I think we'd agree, like numbers that individual businesses are reporting, and actually CEO optimism that's probably a bit better than we've seen for a couple of years, that is better than expected. So over time, the earnings that a company delivers will ultimately determine its share price. But in short-term periods, the general mood of the market will influence its share price. And that, of course, is impossible to predict. All you can worry about is that you're owning businesses that you think are going to keep growing, and over time the share price will grow and the dividends will flow and all those sort of things. So I think generally we'd be pretty happy with how things have gone.
And I think there have been a lot of disasters in the market that we've avoided, which is a really key part of investing. When we come into March, we come into a period where a lot of dividends get paid, and that'll be certainly a good time for a lot of the shareholders that we represent, and we look forward to bringing you some more news at the end of March as the markets evolve yet again.